Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now let's take a look at the correlation between oil and the euro. Now this is a chart, this is a screenshot from the OptionsXpress website of EUI. Now EUI is the underlying for when you want to buy options on the euro. Now the way this works is that if you are bullish on the dollar, because remember the ISE options are dollar-based, so if you're bullish on the dollar, then you would buy calls. And if you're bearish on the dollar, you would buy puts. So in this case, as EUI is going down, that shows how the dollar has gone down as oil has gone up. Now, the reason I'm showing you this is from May of 2007 until today, just to or till I believe it was Thursday when I finished this screenshot. This is to kind of give you an idea of the fact that, yeah, you see a little bit of correlation, but it really doesn't look like much. You see oil up 75% in that time frame, but the dollar's only gone down against the euro maybe 10% or something along those lines. So it really doesn't look like it's that much of a correlation, because one thing that we hear all the time on CNBC is, well, oil went up just because the dollar went down, and it's really just dollar-based because of oil. Well, when we look at this, it doesn't really appear to be that way based on the percentages. But I came up with, and as I was looking at this, I'm like, that doesn't seem very right to me as we're going through this. But I came up with another chart view that kind of gives you a better idea of how this can actually work in terms of the percentages. Look at this. These are the same two charts from the same time frames. And what we're seeing in here, it's that you can see on the top chart, this is USO. And USO is actually the ETF that tracks oil. And the same is true for this chart as well. So we see on the top chart how USO goes up higher, and then we see how it peaks out right when oil itself was around 147 a barrel. USO is approximately, the value of USO is approximately, I would say, 80% of the value of oil in general. So if oil's at $100 a barrel, you'll see USO at $80, approximately. It's not exact, but that's about how USO is. You can see where it peaks out, but let's take a look at the dollar below. Below is a chart of EUI. So we can see in here, as the dollar goes lower, oil does continue to go higher. One thing that's interesting, though, is we can see around April, when EUI got down to around the 62 level, it kind of hit support. So the dollar actually hit support, but up top, we can see that oil continued to go higher around the time of June, and then, of course, it peaked out in July. Well, the dollar had already been at support. So what's interesting about this is that as soon as the dollar started to continue to go higher, or start to make its reversal and go higher, at least versus the euro, that's when oil started coming down. Also, we can see the pullback in the dollar versus the euro around September, and you'll notice the same thing on USO going to the upside around that same time frame. So in this case, we can see oil going down, and this is as of Thursday. Now, the other interesting thing is we see that the dollar might be hitting a top right in here versus the euro. We can see that on the far right side. Now, does that mean that maybe the dollar is starting to form a top, and this could be a time for oil to make a reversal and start going higher? I don't know. That's your decision to make as a trader. One thing that I don't get into is predicting the market, and especially in this time frame, I'm definitely not going to predict it now. But this is definitely something that you can take a look at and look for the correlation from the standpoint of the dollar versus the euro against oil. Now, the other thing that I want to emphasize in the slide presentation as to what we're going to be doing tonight, I'm just going to be showing EUI, the euro, because that's kind of the popular currency that a lot of people look at. But once we go, we're going to be showing some shots from the OptionsXpress website to where we'll show GM versus the loonie, the Canadian dollar. We'll be showing individual stocks against other currencies. So we will be showing others. But in this case, for the slides, we're just going to be showing the euro for right now, or I'm sorry, the EUI. The other thing that I want to emphasize with this is the fact that I'm purposely wanting to show some of these charts live tonight from the standpoint that a lot of news is happening. Like Steve had just announced something that I didn't hear right before the start of this event on Citigroup. This is a very news-oriented market, and Steve and I have been traveling the last few weeks. We've done a few shows together, actually, and I've done some slides, and they've been outdated 3 days later because of how much the market's been moving. So we are going to be showing some live shots tonight once the slide presentation is done. Now, let's take a look at this on the same chart again. This is over the course of 3 months. And this is what I want you to notice. The blue line is representative of EUI, which is the dollar versus the euro, and the red line is representative of USO. What we can see in here, EUI went up just under 25% over the course of the last 3 months. So we've had quite a huge bull market in the dollar. But on the flip side, we can see oil going down about twice as much. So if you're looking for a percentage correlation, which is what we talked about earlier, it appears that oil, at least over the course of the last 3 months, is a little bit over twice the correlation of the dollar versus the euro. Now, does this mean this is always going to be the case? No, this is just recently from the standpoint of what's going on with it. Now let's talk about gold. A lot of people view gold as the great inflation hedge. There's a lot of worries about inflation a couple months ago, and so a lot of people were recommending gold, buying options on GLD perhaps, or buying GLD in general. There's several ways that you can invest in gold. You can own it as an ETF. GLD is the ETF that tracks the price of gold. You can buy options on GLD, same way you would for options on a stock. You can use gold futures. You can just use the physical product in general. Just from watching TV, I've never seen so many jewelers have commercials for turn in your gold for cash now. The value of gold has never been higher, and a lot of people are looking to do that right now. So you may want to really stay in tune with the price of gold and where it's been, because it's pulled back quite a bit relatively as to where it was a few months back. So food for thought with that. Another thing that a lot of people are the way that you can have exposure to gold would be by buying a gold-based stock. Find a stock that is based upon the price of gold, and if the price of gold goes up, the stock value typically goes up. You can find that as well. Now, what we want to talk about right now is gold versus the greenback. And if you've never traded currencies before, the greenback is the US dollar. Who would win? Well, let's take a look at a few screenshot graphs. First one that we have right here, this one I think is kind of interesting. This shows GLD is the red line, by the way, and the blue line is EUI. We can see in here that it kind of has a negative correlation to it in terms of if the dollar gets worse in value, gold has been doing better. Now, just like oil would move over twice as much percentage-wise as what the dollar would. The same would be the case as gold. Gold has moved twice as much. We see back when gold hit its, I believe gold is over when, excuse me, when gold hit its peak in March, we can see that the dollar was definitely going down. And we are getting a little bit of something of convergence right here in recent times. Gold is coming down, the dollar is coming up. But one thing that's, as you're looking at this chart, it's difficult to see if this is an exact correlation or not based upon like what we were talking about on this, from the standpoint of oil versus the dollar itself. So in terms of gold, a lot of this is dependent upon the times that we're going through. For example, we were actually on the gold standard until 1971, I believe it was, when President Nixon took us off of that. Up until that point in time, gold was locked in at $35 an ounce. Well, gold's obviously a lot higher than that right now. So different times have different correlations or non-correlations in terms of gold versus the dollar value itself. Now let's get into the stock market. This is probably the main reason why what we wanted to talk about tonight. What does the stock market think of the dollar? And the other thing that we want to talk about, how do different situations create different opportunities?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.